Do you want to know why the oil price crash happened? Can you make a profit from that? Hey everybody, welcome to Work From Home. Today we're going to go over the oil price crash and if you shall invest in USO stocks. Make sure to watch until the end because it's one of the most amazing financial events I've ever seen. It's hard to believe that the price of any commodity, let alone oil, can dip into negative territory. But that's just what happened to oil prices. COVID-19 has prompted lockdowns, shuttered factories, and stopped people from traveling. The global economy is contracting. The pandemic has also reduced global demand for oil by about 29 million barrels a day from about 100 million a year ago. OPEC and other producers agreed to cut production by 9.7 million barrels a day, far less than the decrease in demand, leaving a huge surplus of oil on the market and no buyers. The storage capacity on land has filled up quickly. Many oil importing countries have stored large quantities of oil, taking advantage of cheap prices that may not last. Some oil producers, hoping to maintain their market share, have taken to storing their excess oil at sea, leasing tankers at high costs. Some are believed to be paying in excess of $100,000 per day for each tanker. Oil prices will come back up. So, how have Alberta oil prices and even future prices for West Texas Intermediate WTI slipped into negative territory? It starts with the futures contracts for WTI, oil to be delivered in a few months at today's price. It lost $6 barrel on Monday, fetching $11.66, but ended the day at $37 as holders of futures contracts try to dump their contracts before the oil is actually delivered with nowhere to store it, but primarily derived from oil sands, referred to as Western Select, typically sells at $10 to $15 below the price of WTI because it has to be extracted from deep rocky terrain that makes it harder to refine, and it also has to be transported thousands of kilometers to American refineries. An oil refinery is seen in Kansas. Oil from Alberta's oil sands is processed at American refineries, the Canadian Press/AP Chile Radel. And so Alberta oil prices have come negative in the sense that the benchmark price is now lower than the cost of production, transport, and storage. This state of affairs cannot be expected to last for long. Producers in the short term may accept prices below their variable costs as long as they are able to pay some of the costs they will incur. Even if oil production shuts down, as time passes, more and more rigs will stop operating. Technically, a few will be kept operational in order to avoid being compromised, and a new balance between supply and demand will be established at prices that exceed the total average cost. But this doesn't bode well for either Alberta or the United States. Collateral damage. Alberta oil is now the collateral damage of the oil war between Russia and Saudi Arabia, with COVID-19 launching an additional attack. Either of these two factors could have disrupted Alberta's oil production, but Saudi Arabia and Russia hostilities combined with the global pandemic have proven to be catastrophic for Canada and could have a similar outcome for the US energy industry. Russia and Saudi Arabia depend heavily on its oil revenues to sustain their economies. Of course, Saudi Arabia's economy is less diversified than the Russian economy, but both share a similar distortion, where oil revenues represent a very high share of their GDPs. Saudi Arabia about 15%, Russia 38.9%. Budgets. Saudi Arabia 87% and Russia 68%, and exports Saudi Arabia 19% and Russia 59%. It's difficult to believe that either country can do with such low prices. Russia needs a price of $60 a barrel to balance its government budget, and even a higher price to balance its current accounts, meaning exports of goods and services minus imports of goods and services, plus net short-term capital transfers. Should you buy USO shares? The United States Oil Fund, NYSE MKT USO, is a popular way for retail investors to attempt to trade at oil prices. On the surface, it might seem like a smart move. Buy USO, a fund that's designed to track the daily movement of West Texas Intermediate oil prices and make money when oil prices rebound, right? The obvious answer will seem to be yes, you should buy USO. After all, USO is still down 83%. making it a far better way to profit from a resurgence in oil prices than oil stocks like ExxonMobil or Phillips 66, down about 1/3 at recent prices, that actually require the holder of the contract to take physical delivery of crude oil at expiry. Obviously, USO is in the business of taking physical delivery of oil, so it sells out of contracts before they come due each month, rolling the proceeds into contracts set for future delivery date. In a more normal market, this works fine. However, what we are experiencing right now is anything but normal, with record levels of demand destruction and massive oversupply as producers have been slow to cut output. US production has started to fall, but Saudi Arabia and Russia, the world's third and second largest oil producers, have reportedly increased their oil output in April. There are significant risks that it will be increasingly difficult for USO to avoid being left holding contracts it cannot find a buyer for in the weeks and months ahead. USO's management simply might not be able to keep the fund liquid if it keeps getting forced to offload futures contracts for such a massive loss as we saw in April 20. The risk of a total wipeout. It's not very often an investment fund's biggest problem is investor interest in that. Along with the collapse in demand for oil in the US is why USO is at risk. The fund has seen substantial capital inflows at a time when oil demand is falling to Vietnam War-era levels, pinching USO into a corner from which it must buy futures to meet the demand from new investors. Even when the demand for the crude those futures promise delivery of won't be there. And that puts USO in a terrible position. Even drastic measures to push some of its investments into 2021 futures might not be enough to offset the risks of another April 20 happening in the months ahead that the fund cannot survive. A worst-case scenario could include USO being forced to liquidate all of its futures holdings to meet its financial obligations. If that were to happen, USO shareholders will be completely wiped out. Even if oil prices look like they're starting to improve. What do you think about it? Comment below. Subscribe and turn notifications so you won't miss more videos of how to make money from home and much more. Check out this video and I'll see you soon. Take care.